please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, on to another big prominent, another big story, in fact, that has been, we have been playing out all of yesterday. Prominent Indian origin fund managers have hit out against SEBI's April 10th circular that, among other points of contention, puts a ban on non-resident Indians, overseas citizens of India and resident Indians from holding beneficial interest in an FPI, that's foreign portfolio investment. Now, talking to the media on the sidelines of a roundtable yesterday, fund managers allege that SEBI circular was racist and discriminatory in nature. They say it caused a lot of anxiety among the NRI community and should be scrapped. We spoke to some of the stakeholders who could be affected by this circular. Let's listen in to what they had to tell us.
The problem is that no institutional investor or anybody would give money to an entity that doesn't have a controlling person, right? So there has to be a fund manager in charge. And the minute you say, I'm the fund manager in charge and I'm of Indian origin, the circular says, well, you can't be. Right, you cannot utilize the FPI route to bring in investments into India. So there's a basic problem.
So Nandita Parker cannot be the fund manager for Karma Capital. It'll have to be a foreigner. I mean, that is fine.
Exactly. So NRIs, right? If they want to invest in India, they would not come through my fund. They could come through a foreign fund. A Nigerian could set up a fund and invest in through the FPI route. A Russian could do it, but I, who have been postulating the India investment case for 25 years, wrote the first India strategy report 1995, and have been an ambassador for India, can't do it.
So is the problem really with thresholds, or is the problem with managing that fund, irrespective of the Indian person's economic interest?
Thing is that it is very broadly defined. I think if the intention is to collect information with economic ownership, what is really required, if money is laundered, you need information. I think nobody has a qualm with that at all. But the way in which the circular has come out, it almost puts total ban on any foreign fund which is managed by NRI, OCI, PIO and resident Indian institutions, which are actually approved and often encouraged by Indian government in the last few years.
The intent being to make sure that there is no more round tripping. I think that would have been curbed to a large extent. We've tightened treaties, we've put guard in place, there's so much that's happened already. So is this getting a little excessive?
We are not saying, the beneficial ownership as a context, it is good. You have borrowed it from PMLA, but PMLA also does certain exemptions. Like Cat 1, Category 2, the funds which are listed, they are not exempted today, while in PMLA that is there.
One more thing on PMLA. PMLA does not prohibit anybody from using the FPI route. It's only for KYC, which we are happy to disclose and provide KYC.
If the intention of the circular from SEBI is not prohibiting Indian origin people from getting overseas money into the country, managing that money, I mean, this surely will get sorted out. What's the road ahead, according to you?
As was discussed, the issue is not as much about the threshold percentage as it is about bringing in the concept of beneficial ownership linked to control. And that is where the main crux of the issue is, that in your quest to try and, police this movement of alleged movement of funds or round tripping of funds from India back in, you are now prescribing that anyone of Indian origin who is a beneficial owner in a fund and which he or she is controlling is impacted, and you cannot have that person in charge there. So, well, even if those funds don't close down, you will basically replace them with pure foreigners. So what is the purpose being served?
Nandita, what should be the threshold? I mean, if we get down to it, 10, 15%, as Surabhi pointed out, that works?
So, I mean, those are something that we've lived with, okay? Earlier, there was sort of a notion that, there can be almost an unlimited NRI investment in any fund. Or most of us thought of that as something like a 50% limit. So we kind of went by that as an industry practice more than a given threshold. We kind of took it at that. Now, if you say, you know, there's a question of that limit, and NRIs can only go through another route through a foreign fund manager. The first problem with that limit is that how do you define NRI, and which form should I have, and what checkbox should it have? Should it be based on a person's race? And if they are 10% NRIs, you know, if their grandfather was a person of Indian origin, I mean, this is craziness. I have never heard of any country discriminating against its own people. This is what this circular has amounted to. When I've discussed it globally with investors, they are shocked, and I am sorry to tell you, I'm ashamed of having to explain this to people, that anybody sitting over here in India would come up with something like this.
Okay, well, let's move on now to a CNBC TV18 exclusive. The Reserve Bank has put its foot down on the issue of big dividend payments to the government. The central bank, which released its annual report recently, highlighted that it was adopting a new surplus distribution policy. The RBI stated that since continuous and substantial transfers weaken the RBI's balance sheet going forward, it will have to consider its own provisioning requirements before transferring the annual surplus to the government. The government, however, is not on board. Sapna Das joins in with more details.
Well, it is significant that the Reserve Bank of India has now stated publicly and rather in its annual report that it is not in favor of large and continuous surplus transfers primarily to the government, because that will weaken its balance sheet. So basically it has to keep some provisioning amount aside for its own self before it starts thinking about surplus transfers. Here also they have probably adopted a methodology for arriving at those provisioning requirements. The second aspect, of course, even in terms of the unrealized gains from valuation, here again they have made it very clear that this is not meant for distribution. So a very clear message going to the Finance Ministry. But of course, we have been speaking to the DS Secretary on this issue, Mr. Subhash Chandra Garg, and he's already indicated very clearly that this matter has not reached a finality. They are still under discussion with the Reserve Bank of India, and the fact that there is a difference of views between the regulator and the government on this matter. So the government at its end continues to push forward. Probably we will see another interim dividend going forward in this current financial year. One has already happened in FY18. The question of dividend, or rather the interim dividend, is a direct fallout of the fact that the government and the RBI are not seeing eye to eye on this economic capital framework structure, wherein government is going on saying that please transfer your entire surplus to us. We have a right over that, and RBI is saying that no, there is a new policy in place now. I first need to take care of my house, and then I can think about these large surplus transfers. Matter is still going on, but government not giving up clearly at its end.
On Dalal Street, we saw extended losses at the last hour of trade after a range-bound session yesterday. So the Sensex and the Nifty ended the session with losses of nearly 1%, and we had the mid-cap index also turning into the red in the last few minutes. Large cap FMCG stocks, particularly ITC, HUL, fell, pulling the Nifty lower. All private banks, barring HDFC Bank, declined, whereas ICICI Bank ended 2.2% lower. Sonia joins in to apprise us of all the cues we need to work with this morning. Sonia.
Hi, Ekta. Good morning. Well, you know, the macros have been weak for a while. It was just a matter of playing catch-up to the markets, I guess. Yesterday, the markets used the weak macros as a reason to correct, and we saw that slide in late trade. The macros are not looking good, so the expectation is that the downtrend would continue in our markets today as well. Brent crude, as we know, has risen to a 2-month high of $78 a barrel. The rupee has weakened. It hit that all-time low yesterday of 71.21 to the dollar. The 10-year bond yield has hit that 8% mark for the first time since December 2014, and the dollar as well is near a 1-week high of 95.2, as the risk appetite globally is very fragile. So all of these points put together, the weakening rupee, higher Brent crude prices, higher dollar, all of this will perhaps put further pressure on our own markets. The US markets are shut, so we don't have cues from there, but the initial tick from Asia suggests that perhaps there could be some more trepidation in early morning trade. There are sell figures coming in both from FIIs and DIIs, so there was some amount of profit taking yesterday as well. If you look at the FI numbers, FI sold about 21 crores yesterday. DII sold almost 560 odd crores. Even in the index futures, the FII sold almost 394 crores. So not looking like a good setup. A lot of the traders we spoke to yesterday indicated that this could be the start of a bit of a corrective phase in the market, and you should be prepared perhaps for lower levels.
Okay, all right. Sonia, what about stocks we should focus on in today's trading session?
Well, Jet Airways could be in focus once again. ICRA has downgraded Jet Airways credit rating to BB from BB+. They cite the weak fundamentals, the increasing balance sheet pressure, as reasons for the downgrade. In fact, a lot of pockets could be under pressure because of the weakening macro. So NBFCs, banks could be in focus as bond yields have hit that 8% mark, rupees at 71.2. Because of the way crude has risen, you could see the aviation stocks, paint companies, tire companies too, that could be under pressure this morning.
Okay, all right, Sonia. Thanks very much for that. So that's an update on all the cues and news we need to work with for today. But on to some corporate action now. Our colleague Reema Tendulkar caught up with Risto Ravanan, the MD and CEO of Mindtree. They had their analyst meet yesterday. He says the deal pipeline is significantly higher than before, and their aim is to get back to margins of around 17 to 18%.
On win ratios, for example, in 2016, our win ratios were about 22-23%. So if I participated in $100 worth of deals, I would win about 22-23. Now it's probably become 33-34. So it's about a 10% improvement in the win ratios over the last 2 years. Pipeline is almost, I would say, significantly higher, almost like multiples of what the pipeline used to be 2 years back, and much larger than what the pipeline used to be even last year this time. We are conscious that our margins are below our comfort level right now. We got hurt by a few things, including the acquired entities, and the integration had its own challenges, and we are now slowly working through all of those issues right now. Our comfort level was in the previous cycle when the rupee was about 62-63 kind of a range. Mindtree was at 17-18% operating profit or EBITDA level. Trying to get back to that kind of margins is the focus. Now, maybe it will take me more than a year to get there, but that's the priority for the leadership team. So over the next few quarters, we expect that bottom line growth will be faster than top line growth. Amongst our current large customers, one customer is still going through some business challenges in terms of, if I look at some of their recent reported numbers, management changes, etc. One customer is still, I would say, is still not completely settled down. I think it's still extremely choppy. The troubled customer that I spoke about is one of our BFSI relationships there. But even if you leave that client-specific issue aside, we are not seeing BFSI do as much of transformative or innovation-led work, grow the business, digital kind of work within our portfolio at the moment.
Okay, we'll keep getting you the conversation all through the day here on CNBC TV18. Mindtree Management speaking to Reema Tendulkar. But let's focus on the Asian markets. When we opened up the show, we saw that most of those markets were trading in the red. Now the Nikkei has done a bit of a U-turn of sorts. It's recovered a goodish bit, more than 110 points from the low point of the day. So sharp recovery is what we're seeing there. It's not just the Nikkei. I think the Kospi as well has moved into the green. When we started off the show, that market in fact was trading in the red. So that as well has recovered. Good to see some green on the screen. Maybe we could just get the initial rates coming in from the Hang Seng as well as the Shanghai market. The Hang Seng, the first tick actually was in the green just a short while back. It's holding with a mild 30-point bump up in the last few minutes. The Shanghai market as flat as can be. So some bit of a bounce back is what we're seeing